Trump accounts, whatever you think of the name, and people have strong opinions in both directions. Setting politics aside, the planning question underneath is more interesting than the headlines suggest. Because for high net worth families, this isn't one decision, it's two. And the second one is genuinely harder than the coverage I've seen has acknowledged. The first decision is whether to claim the $1,000 federal seed contribution if your child is eligible. For almost every eligible family, this is an easy yes. The second decision is whether to keep contributing additional money on top of that seed, up to $5,000 per year per child, alongside the 529 plans, custodial Roths, and other vehicles you may already be using. That second decision is genuinely harder, and it depends on details that most coverage glosses over. In the next 8 minutes or so, I'll walk through what Trump accounts actually are, how they work mechanically from birth to age 18, how they compare to the alternatives high-income families typically use, and a framework for thinking through both decisions. Trump accounts are a new type of traditional IRA for children, created under Section 530A of the Internal Revenue Code as part of the OBBA, the One Big Beautiful Bill Act. The legislation signed July 4th, 2025. They're sometimes called the MAGA accounts in the legislation as an acronym for Money Account for Growth and Advancement. At a high level, they are an investment account in the child's name, designed to compound from birth to age 18 in low-cost US equity index funds. Then convert to a regular traditional IRA where the child becomes an adult. The fundamentals. It's a traditional IRA, so tax deferred, not tax free. Any child with a social security number who hasn't turned 18 by year end is eligible to have one, and unlike a custodial Roth, no earned income is required. For US citizen children born between January 1st, 2025 and December 31st, 2028, there is a one-time $1,000 federal seed deposit with no income limits. Annual contributions from all sources combined are capped at $5,000 per year, indexed for inflation after 2027. Employers may contribute up to $2,500 per year through a Section 125 cafeteria plan. But importantly, that counts toward the $5,000 cap, not on top of it. The launch date is July 4, 2026. No contributions can be made before then. The legislative intent appears to be giving every American child a head start on retirement saving, leveraging compounding from age 0 rather from age 22 when most people start their first 401k. The combination of federal seed plus 18 years of compounding is meaningful even without additional contributions. $1,000 invested at birth in a US equity fund, growing at a long-term historical rate, can grow several fold. By the time the child reaches age 18, it can be a significant sum. Let me walk through how a Trump account works mechanically, from the day the parent opens it to the day the child turns 18. A parent or guardian opens the account starting July 4th, 2026 by filing IRS Form 4547 or registering at trumpaccounts.gov, only one account per child. For eligible children, Treasury deposits the $1,000 federal seed directly into the account upon valid election. That seed isn't taxable to the child when contributed and isn't subject to the 10% early withdrawal penalty when later distributed. During the growth period, which ends December 31st of the year the child turns 17, funds must be invested in mutual funds or ETFs that track the S&P 500 or another index of primarily US equities. No bonds, no international, no individual stocks. Tax-deferred growth. Withdrawals during the growth period are generally not permitted before January 1st of the year the child turns 18. At 18, the account is generally treated as a traditional IRA. Investment restrictions loosen. Standard IRA early withdrawal rules apply. 10% penalty before 59.5 unless an exception applies. First home purchase, qualified higher education, qualifying medical expenses, and so on. And IRS guidance permits converting the account to a Roth IRA at age 18. The conversion creates ordinary income tax in the year of conversion. But if the child has little other income, the bracket may be very low, after which all future growth is tax-free. 3 mechanical details deserve special attention because they are the most easily misunderstood. First, the investment menu is genuinely restrictive. During the growth period, money must be invested in funds tracking the US equity indices. For an account that compounds for 18 years before the child can touch it, the equity-only requirement is appropriate. The time horizon supports equity risk, but it's a real constraint compared to other vehicles. Second, the basis tracking matters. When the federal seed and any employer contributions are eventually distributed, they are taxable as ordinary income, but not subject to the 10% penalty. When parent or family contributions are eventually distributed, the original contribution amount comes out tax-free as basis, and only the growth on those contributions is taxed. Third, the Roth conversion option at age 18 is a meaningful planning lever. A 19-year-old college student with little other income may pay very little tax to convert the entire balance to a Roth IRA. And after that, all future growth is tax-free for the rest of the child's life. These three details, the equity-only restriction, the basis tracking, and the Roth conversion option, are what separate. The seed is essentially free money from how do we actually optimize this account over 18 years. For high-income families with multiple savings vehicles already in motion, the more useful question is how Trump accounts compare to the alternatives. A 529 plan, tax-free for qualified education expenses, parent asset FAFSA treatment at about 5.64%, and Secure 2.0 allows up to $35,000 of unused balance to be rolled into a Roth IRA for the beneficiary. For families whose savings goal is education, a 529 generally still wins. A custodial Roth IRA. Extraordinarily powerful when the child has earned income from babysitting, lifeguarding, summer jobs, family business work, but only to the extent of that earned income. For a 4-year-old, this isn't a viable vehicle. For a 14-year-old with a summer job, it can be exceptional. A UTMA or UGMA account, most flexibility, can be used at any age, but assets are taxable annually under Kitty tax rules and become the child's property at the age of majority. And Trump accounts occupy a specific niche. They're the only vehicle that doesn't require earned income, doesn't require an education-only purpose, comes with the $1,000 of free seed money if you qualify, and uses a traditional IRA tax treatment. The trade-offs are the narrow investment menu, the student asset FAFSA treatment, and the lockup till age 18. None of these vehicles is universally better than the others. Each occupies a different planning niche, and for high net worth families, the right answer is usually a coordinated combination, not a single account type. Most generic Trump account coverage doesn't address what specifically matters for high income families. 5 points worth thinking through. 1, the FAFSA implication may not matter for your family. For families whose income is high enough that no need-based aid is realistically expected anyway, typically households well above the $400,000 in income, the difference between student asset and parent asset treatment is mostly academic. For families closer to the financial aid threshold, it's real money. Know which side of that line you are on. 2, the equity-only investment restriction is appropriate for the time horizon. An account that compounds for 18 years before the child can touch it can sit in 100% equities without significant concern. 3, the age 18 control transfer is a real planning consideration. Whatever balance is in the account becomes the child's asset at age 18. A 4-year-old today, 14 years from now, will have legal control of an account that may hold a 5 or 6-figure sum. UTMA, UGMA has the same issue. 529 plans don't, because the parent retains control. Whether this matters depends on the specific child and family circumstances. 4, the Roth conversion at age 18 is a powerful high net worth lever. If the child has little other income at 18, typical for a college student, the conversion may happen at 10 or 12% federal bracket. After conversion, all future growth is tax-free for the rest of the child's life. For a long horizon account, this can substantially improve the after-tax outcome. 5, the employer cafeteria plan opportunity matters for some. Employers may offer a Section 125 cafeteria plan that allows employees to contribute up to $2,500 per year to their dependents' Trump accounts on a pre-tax basis. For employees in higher tax brackets, the pre-tax mechanic is meaningful. But this counts towards the $5,000 annual cap. The consistent thread across all 5 points is this: Trump accounts are not a one-size-fits-all decision. They are a planning lever with specific characteristics. And the value to a particular family depends on the family's circumstances and the goals they are saving toward. Back to the framing from the start of the video, there are really 2 decisions here, not one. Decision 1, should we claim the $1,000 federal seed for our eligible child? For high net worth families, the answer is generally yes. The seed costs nothing. The math is overwhelmingly in your favor. And there is no income-based eligibility limit. Decision 2, should we make ongoing contributions on top of the seed? Up to $5,000 per year. The answer is, it depends. Most high net worth families may want to first maximize 529s for education goals and custodial Roths if the child has earned income. Trump accounts may be a complement, not a replacement to those vehicles. For decision 2 specifically, the considerations that typically tip the answer one way or another, reasons to lean toward making the annual contributions. You're already maximizing 529s, custodial Roths, and other vehicles and have additional savings capacity. You specifically want a vehicle that's not earmarked for education. You're planning to use the Roth conversion at age 18 as part of a long-term planning. Your employer offers Section 125 cafeteria plan contributions, or you simply want to start the compounding clock as early as possible across multiple vehicles. Reasons to lean toward not making the annual contributions. Your education savings goals are unmet. Your child has earned income that could fund a custodial Roth IRA tax-free instead. The equity-only investment restriction conflicts with your asset allocation preferences, or the FAFSA student asset treatment matters for your family's financial aid picture. For most high net worth families, the answer to decision 2 is going to be yes for the seed, modest if anything for ongoing contributions, and reassess as your child grows and other vehicles fill up. But it's a real conversation, not a default. 3 questions worth bringing to your next planning conversation with your planner. 1. When registration opens later this year, does your family have a process for claiming the $1,000 federal seed for any eligible child? It costs nothing. 2. Where do ongoing Trump account contributions, if any, fit in the priority order alongside your existing 529 plans, custodial Roth IRAs, and UTMA accounts? That priority order should reflect your specific goals for each child. 3. If your child becomes an adult in roughly 18 years with 5 or 6 figures of money in their name, does your family have a plan for the conversation about how that money is used, including the potential Roth conversion at age 18? Those 3 questions don't have universal answers. They are the questions that ensure Trump accounts are integrated into a deliberate plan rather than treated as a one-time decision in isolation. Drop in the comments which of those 3 feels most relevant to your situation right now. I read every comment.